Hey, Randy, my question is, how close do you think it's going to be between 50 and 25?
Oh, it's definitely a close call. I think the markets have it right this time. Often the markets don't seem to get it right and anticipate some wild moves by the Fed. But here I think they really have a real debate internally of what they should do at the first step. You can look to the inflation numbers and say, hey, core PCE, which is their favorite measure, that's been stubbornly staying above 2.5% for the last 3 or 4 months. So we better move carefully. On the other side, you say, looks like the labor market is weakening a little bit more rapidly than we would like. And with long and variable lags monetary policy, we better get going. So I think that's going to be the debate around the table.
Yeah, I love that you brought up the long and variable lags. We obviously had them on the hiking cycle. Do we also get them on the cutting cycle?
For sure. And that's one of the challenges that some people would say, well, it's too late. Substantial slowdown is baked into the cake. And I do think that there will be a substantial slowdown the rest of the year, not necessarily recession, but a substantial slowdown because, as the Fed has kept the interest rate constant, inflation has come down. And so the inflation-adjusted interest rate, that is the real interest rate, has gone up substantially over the last year.
So it gets to a question, though, Randy. So when we do get this rate cut, whatever it may be, next Wednesday, Powell's still got to come out there and answer some questions. And I'm sure everyone's going to ask about the pace of future rate hikes and I guess the steepness of those hikes in the short term here. How much of his hand does Powell need to show or will show next Wednesday about the future rate hikes beyond September 18th?
I think that's really what the markets are going to react to because, they're right on the edge between 25 and 50, but it's what's coming in the rest of the year. And we'll have the economic projections, so we'll get some new information from his colleagues and himself about where things are going to be going. And so that's really what the market is going to react to. His challenge is that if he goes 50 now, it's going to be really difficult to say, well, maybe we'll just do 25 at one of the next 2 meetings. So he's kind of committing to 150. And does he really want to do that? Maybe. But I'm not sure he's completely there.
This gets to this also issue, too, that we're heading into this rate easing cycle at a time where everybody is hyper-focused right now on fiscal conditions, particularly given a big election and maybe some potential big policy changes over the next few years that could maybe exacerbate that fiscal situation. You spent some time on the Council of Economic Advisors, had the president's ear here. I mean, what's sort of the conversation that the Fed has to have amongst themselves with regards to fiscal policy that they effectively have no control over?
Sure, that's one of the things that the Fed has to deal with. There are a lot of things outside the Fed's control. People think the Fed controls everything, but it really doesn't. And fiscal policy is one of those key things that it doesn't control. And so it has to make some estimates. It'll probably do some alternative simulations of the model. We used to call them alt-sims to look at, well, what if we get this one approach to fiscal policy? What if we get another approach to fiscal policy? I think regardless of who the next president is, I think we'll continue to have a fair amount of spending and a fair amount of fairly high deficits. One may be larger or smaller under one president or the other, but I think they're assuming that there's going to be a fair amount of fiscal impetus in the economy going forward.
So, Randy, does that mean that growth's going to reaccelerate? Like, if we get the soft landing and we get the fiscal spend, no matter who's in the White House, do we have growth reaccelerating and maybe inflation reaccelerating?
That's exactly what they have to worry about. And growth has been reasonably good. The unemployment rate has stayed remarkably low. I mean, people are rending garments over it being in the low 4s, but my goodness, low 4s is a really, really good number. It's just we've been in the unusual situation of a near 50-year low for the last year. I think it's likely that we could get a 5 handle on the unemployment rate over the next 6 months or so, but it still wouldn't necessarily mean recession. That's just a slowdown, which I think would help to reduce the inflationary pressures. But we'll have to see.
I mean, 5% sounds bad. I know historically that's like nothing, but compared to where we were, that would be kind of aggressive.
Yeah, I think because I do think the economy will slow. As I mentioned, I think there's been a lot of so-called real tightening as inflation's come down, but interest rates, the Fed's interest rates stay constant. The real cost of borrowing has gone up. Also, something that's great for American households is that real wages have started to grow over the last year. But what that also means is that that firms are going to be a little less sanguine about hiring people than they have before. And so I think that combination of things, plus the old fiscal stimulus that came in to really boost people's savings, we're not, they've kind of spent a lot of that down. So I think there's going to be more challenges going forward.
How much then does a rate cut or multiple rate cuts actually goose the economy? I mean, let's say we get that 100 basis points over the next few months as the market thinks we're going to get. Do you think that will have an immediate and direct impact?
It'll certainly have some impact on some asset valuations. Obviously, the stock market seems to like lower interest rates, and a lot of private equity valuations would probably go up. On the real economy, in terms of housing market and spending and investment, it'll take a little bit more time. That's where the long and variable lags come in. So I have a little bit on asset prices, and then a longer tail effect on the real economy.